Yeah, Sarah, we've been talking about this all year, you and I, and it really has to do with the flight to safety, global growth issues, ex-United States that will decelerate, consumer staples as well as healthcare. We're overweight, and we believe that this will continue into the end of the year. Bob Hassani has it 100% right. It's global growth ex the United States.
Mark, do you share that view that global growth is slowing and therefore stock portfolios need to change?
I do share the view that global growth is slowing. I also think the leadership of the market, which has been technology year to date, is obviously going through some headwinds. I think the Chinese tariff concerns are absolutely at the forefront of investors' minds. I've been talking to the buy-side accounts that we deal with at JMP, and the specter of more tariffs and the ping-ponging back of tensions is not dissipating, and that will continue to weigh on this market until we resolve that, I think, through the end of 2018.
Chad, we're not getting a lot of confirmation, though, in the bond market that there's any sort of growth scare or anything like that. I mean, this started with the fear of higher rates and the Fed raising, and yields have sort of stabilized around lower levels right now. What does that tell you for stocks?
Well, I think for the U.S. equity markets, what it's telling you is that this is going to be that the earnings are going to come in okay-ish this quarter, but the focus is really a concern about year 2 and 3 on the growth side. Keep in mind, a lot of the U.S. multinationals, their embedded expectations for growth is on the EM side. And as you start to see China decelerate, that deceleration is having a meaningful impact on the European economy. Now, the reason why I'm mentioning this is because the growth sector overall has had a tremendous run because global growth has been so ebullient. But as you see a moderation of that, there's a high correlation that these growth companies will actually start to underperform value. So you want to overweight value at this inflection point.
Mark, would you agree? Growth versus value?
Well, I'm a growth investor over time because I think it's very hard to properly assess when those multiples will expand, and we've seen great growth in those growth stocks. I still think that's where you want to be for the long term. I still think the future of our economy and the future of innovation is really in tech and healthcare, and you will continue to see that. If we have an air pocket like we're having now and multiples contract, that's worrisome. But I think for the long-term investor, with the kind of innovation that we've seen, the kind of multiples that we expect over time with these great companies that will go public and will grow the economy, you do not want to underweight these stocks. At times, you're going to have these air pockets. Over the next 3 to 5 years, you want to be overweight tech and healthcare because that's where the growth is in the economy.